All right, let's go ahead and get into it. Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly walk through all the latest news, look inside the current business climate inside the mortgage industry. Each week, I'm pleased to be joined by one of our lender members as my co-host. And this week in the co-pilot seat, the owner of Alcova Mortgage, Bobby Nicely. Bobby, great to see you.
Glad to be here. Looking forward to it.
Always like to let the co-host kind of level set with the audience before we get into it. If you could just tell us a little bit about Alcova, yourself, and we'll get into the conversation.
Sure. Yeah, Alcova stands for Allegheny County, Virginia. Myself and the other two owners started Alcova in 2003. That's our hometown. We were friends from the time we were about 10, 12 years old, played sports together. And so we started the company as a broker in 03, kind of grew it over the years, became a mortgage banker in 08, 09. Great time to become a mortgage banker. So, we're independent, private mortgage company, same three owners that started in 03, and, operate primarily in the mid-Atlantic and South states. Virginia and North Carolina make up about 70% of our business, but we do business from Maryland down to Florida, and then Alabama, Tennessee, some other states we're licensed in. It's up to 15 total right now. So just excited about being on the show today and to talk to your folks and share some thoughts and discuss what's going on in this crazy industry we're in.
Never a dull moment. And as always, our attendees, any comments, questions, thoughts, please feel free to drop them in the chat or the Q&A, and we'll incorporate it into the show. So Bobby, Alcova, born in the wake of the mortgage meltdown, and now we find ourselves in a really additionally interesting time for the industry. A lot of things are different, credit quality and massive amounts of equity in homes for homeowners, but a really tenuous housing finance climate right now, just based on largely skyrocketing home values and more recently skyrocketing interest rates. The Federal Reserve kicked off their latest two-day Fed policy meeting today. They'll speak tomorrow. Really, a lot of us in our industry and just in the world waiting with bated breath, not as much as to what the Fed's going to do. I think very high likelihood they're going to raise another 50 basis points, but more the tone, the tenor, the messaging after, playing the inflation is transitory, everything is fine card in the wake of all the moves made by the pandemic. The Fed really has ratcheted up their rhetoric as of late. And your thoughts on the Fed and the really tenuous spot they're in this week?
Yeah, well, I found this out recently. So only 2 of the 12 Federal Reserve members have any real world experience. So 10 of the other 12 have either always worked at the Fed for their professional career or only been in academia and the Fed. So if you think about it, our whole industry and really the whole real estate marketplace is largely right now dependent on 10 people that have never had a real job. So that's kind of the state that we're in here. And I'm like you, I wish they would tone down the rhetoric a little bit. They were certainly late to the party. There's a lot of quotes from last year where they were like, it's transitory, no big deal, transitory. And, obviously it's not transitory, so now they're trying to play catch up, and hopefully they'll measure their words tomorrow. And hopefully they learn a little bit from some of the last sessions where their words have driven markets unfavorably.
Yeah. And this Fed and previous Feds have gone out of their way to not do anything to kind of shock or disrupt or stimulate the markets. But to your point, not been the case here. Right? They were, I think, much too laissez-faire after just massive amounts of stimulus being pumped into the economy post-pandemic, just really haphazardly. But some of it had to be done, but it just got to the point where, you got money? I got, oh my God, everybody was getting money. Nobody had to work. It was just chaos. And then all of a sudden things turn on a dime, and here we are. And that's what makes the Fed's position they're in really tough this week, because the stock market has just gotten completely clobbered. over the course of really this entire year, but even this last month, it's been brutal as well. And then interest rates, mortgage rates, all these people that want to buy a house, affordability is really tough right now.
Yeah, if you think about it, since about 2011, 2012, there's been the Fed put in place. So anytime things get a little bit too volatile in the stock market, especially, I feel like the Fed has stepped in with QE, and they can't do that right now for obvious reasons. And so it's going to be pretty interesting. They're definitely interesting times. And this is a big week, tomorrow, and then the jobs report on Friday. So hopefully we'll have some more clarity by the end of the week on what kind of direction we're in. A lot of the folks that we follow feel like that we are close to the top of the rate range. But who knows for sure.
You're right. You got Alcova started in the wake of the meltdown. It was QE1, QE2, QE3. I forget how many QEs there were, but they were well timed and much needed for the economy at another very volatile time for the economy for different reasons. But now, with the size of their balance sheet, all the bond buying they've been doing, all the stimulus that's been pumped into the economy, Fed doesn't have that luxury now, and it kind of ratchets up the stakes on. And to your point, it's 10 people that have been Fed lifers that hold so much power in their balance right now. It's a little terrifying.
Yeah, it's interesting times for sure. All we can do, I think, speaking from our company and your listeners, and try to focus on what we can control. And that's been our philosophy is we got to pay attention to it. We have to be educated on it because it affects us. But at the end of the day, we still have to make sure that we're focusing on what we can control. And so we spend a lot of our time talking about that, don't focus on it so much that it wrecks your entire day, your week, your month. There's still a lot of business out there. There's still a lot of good things happening in the real estate market. Got to be realistic, but at the same time, keep the gratitude that we have for being in such a good industry, and much different than 07, 08. You mentioned that earlier. We're in a much different spot. So, we can talk about that a little bit if you want to, but don't see it being an outright bubble. So, I guess that's the positive, but it is challenging for sure.
Very well said. A lot of positives for housing. The amount of equity people have, delinquencies are next to zero. Overall credit quality is really excellent. A lot of the technological advances have allowed, companies like Alcova, it's just easier to close compliant loans that are free of any kind of potential fraud or error. And there is insatiable demand for housing. There is so much pent up demand for people that want to buy houses. And to your point, if we are, if inflation has been raging, but a lot of people, to your point, feel like, could be at the top end of that. If rates were to dip back down into the low to mid fours, which is very, very possible, even in the short term, look how quick they've gone up. Yeah. It could really spur, there's the supply issue you still have, but would help the affordability issue. And any house that's going on the market right now is getting gobbled up.
Absolutely. Yeah. I saw a stat. There's like 25% of the houses that were on the market in 2007, but there's 10 million more households than there were in 2007. So just a huge, huge supply and demand differential today that there was when we really did have the bubble in 07, 08. It doesn't mean there's not going to be some consequences. You can't have rates rise this rapidly and the kind of inflation issues we're having without some kind of market dislocation. But we've still got a very, very healthy real estate market. And who knows, we may look back at this, even despite the Fed's missteps, it might be a blessing in disguise to cool things off a little bit. And we may say we're glad that we had that period, even though it was painful, to calm things down a little bit, at least a little bit, because it's just been unsustainable.
Very true. It really has. Just the run up in values. I think the pandemic in general, it just increased the value of housing in general to Americans and their desire to own a home or to own a better home or to have a different type of home. A lot of people working from home now and are just in the house more, even with the pandemic largely in the rear view. And yeah, it's just kind of we needed something to cool things off a little bit, because the pace of appreciation of homes just unsustainable.
Yeah, I can't imagine being a first-time home buyer today. It's just got to be extreme. Well, not got to be. We know that it's extremely difficult. So I feel for those folks, and I think markets. I'm a big believer in the free market. I do believe markets have a way of correcting. Sometimes, though, that's painful. Those corrections can be painful, as we found out, obviously, in 07, 08. But I'm optimistic by nature. I think there's some solutions and things that are happening, that we're forced to get innovative. We're forced to be creative at times like this, and I think that that's going to kind of lead us out of this is some innovation. Um, and so I am excited about that part of it.
This is the Last Week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the owner of Alcova Mortgage, Bobby Nicely. And Bobby, starting to see, because of the rate climate, ARM production. You look at just the stats on new ARM applications are basically double what they were not long ago. And more borrowers may be paying discount points. You seeing that as well as Alcova borrowers getting a little bit more creative to kind of combat the affordability issue?
Yeah, we absolutely have. I mean, I think we had to do some training on ARMs again. We've done so few the last couple of years. We had to retrain the troops on how to do an adjustable rate mortgage properly. But definitely seeing that, definitely discount points as well, particularly on second homes, with the new pricing that Fannie and Freddie rolled out with the loan level adjustments, having to do discount points just to make the deal work, basically to make a profitable loan. So seeing both of those.
Any other product trends you're hearing or seeing just as it relates to higher percentage of your new apps and pipeline population in this kind of change rate climate?
Well, what we've done, the banks have definitely had an advantage, a built-in advantage during the last few months. We're starting to see some of that change a little bit as their balance sheets start to, I guess they're taking on a lot of loans in the last few months, so they're starting to make some adjustments on that. But they had a lot of capital. The Fed funds rate was very low, so we definitely saw more non-agency loans the last 3 months than we've seen in quite a while. A lot of that's balance sheet from the banks, but more of that adjustable rates, discount points. So yeah, non-agency seems to be the trend right now.
It's a delicate dance with the depositories. That was my world for a lot of years before this role. And I just remember walking that line. It's like you have years like these last couple of years, and the banks and the credit unions, they love the fee income of all these, conventional and govy loans you're originating and selling. But then they're like, man, we need earning assets for the balance sheet. And then you get in a climate like this where you have nothing to sell and everything wants to go on the balance sheet. And then you have the interest rate risk and the liquidity risk of, especially if they're fixed rate mortgages on the balance sheet, and bank appetite typically fills up pretty quick.
It does. We saw that change pretty dramatically. A couple of bank partners that we work with, they had lower than what we would call market rates for a while, but it didn't last long. They've had to self-adjust pretty quickly. So, and even some of our competitors' banks, maybe they were beating us pretty badly 60 days ago, and now that's changed.
Talking this past Friday on the Rundown with Rob Chrisman and Chris Bennett of Ice Capital Markets, just about the secondary markets for things like ARMs. They're trying to come back, but just are not back. And I think there's just a lot of reasons that ultimately buyers of mortgage-backed securities filled with ARMs are still a little tepid right now. Just, the interest rate climate's been so volatile, the prepay risk, you buy a mortgage-backed security filled with, 4.5 or 4.25% 5/1 ARMs, B, refi those into 30-year fixed rate loans, to your point, who knows this summer. So I think that's been one of the impediments to the ARM markets, probably. So.
Yeah, absolutely. Yeah, it's tough to find yield. And that gets back to your point about discount points. And, we're trying to advise our clients to keep the discount points down if we can. Sometimes we can't. We have to make a loan work. We need discount points, sometimes multiple points. But if we can keep it as low as possible, because we do think there's going to be an opportunity at some point in the next 12, 24 months to refinance. So that's what we're trying to advise our clients to do. But to your point, yeah, the ARM market, there's just not a lot of yield there.
Yeah. And yeah, I mean, it's like right now rates that's all anybody could talk about because we've had not historic, but the biggest run up in interest rates in 15, 20 years these last couple months. The cash out opportunity though, if rates do come back down, and I'm with you, I do believe that we will see 30-year fixed rates probably with the 3 handle at some point this year again. I just feel like it's gonna be a really volatile interest rate year. The amount of equity that homeowners have is just, it is staggering and historic. Even if, you have a leveling off or even a minor, I don't think we're going to get, because of the demand, there's so much demand for housing. I see no scenario where home values start going down or even really sideways anytime soon because of the aforementioned demand. So that equity is just going to build, and you get a dip in rates, leaders like yourself, I'm sure already thinking about the dominoes you'd start to knock down if you get a correction in interest rates.
Yeah, we're trying to look at it as a 2-for-1 right now. Each new loan we're doing, has the strong potential, if we take care of the client, do things the right way, to be a second loan very shortly thereafter, either as a rate and term or potentially cash out, depending on how they structure the loan up front and how much they put down and so forth. And then, of course, yes, there's a lot of clients that we closed even last year that we know credit card usage is up. We've seen that. Bank of America recently reported that. Some of that's, of course, due to inflation, and people are they're having to spend more money at the household level, whether it be gas or any number of things, food. So I agree that cash out refinance is going to be a huge opportunity when we get this this rate movement, which a lot of us in the industry expect. So I think tough times can give way to good times if you can make your way through them.
Right. It's like, people say, why would you refi 2 3/4 and the 5.25%? Well, if you're paying off 16% credit card debt, all of a sudden 5%, you're saving a lot of money there. That's got to go into the equation. So I think that's a very valid point, and something that hasn't been brought up on this show yet is Americans are, my guess, you already seen some of the stats on credit card debt going up, but I think as we move into the summer months, you're going to see a lot of news stories about Americans racking up copious amounts of credit card debt.
Yeah, they got to pay for those vacations this summer.
That's how I paid for mine. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the owner of Alcova Mortgage, Bobby Nicely. Bobby, we were talking a little before we went live, just the general business climate and something. We're obviously picking who we feel are like the smartest kids in the class to co-host this show, and they're all saying the same thing. Like, this isn't time of opportunity right now. Yes, everybody's talking about the recent run up in rates, but speaking to a lot of the things that you have, the demand for housing, a lot of the strengths to the housing market, what climates like this do to just the industry in general and the opportunity it presents itself. And I know that's the way you're looking at the market right now.
Yeah, absolutely. 2 years ago, we were all going around saying, and even last year to some degree, saying, man, we wish we could find more good people. So then we have a market like this where more good people are available, or you're thinking about whether or not you should keep your good people. It should be a no-brainer decision. But unfortunately, a lot of us, and we all get caught up in it, so we're no different, but sometimes you look so short-term. And of course, the media is they're no ally of us. They constantly pepper you with bad news. So it weighs in on your mindset as well. But yeah, if you look at this as an opportunity, I mean, it's much like buying a stock when the market's down. I mean, if you believe in that stock, if you believe in your people, if you believe in your company, what better time to invest in it, double down in it?
Yeah, very, very well put. And you're right. It's because, we go back to a year ago, it was like people were dying for people. Like you couldn't hire them quick enough, and we're doing crazy things to retain people they like, but maybe even some people that, they would normally not pay a retention bonus to or something like that. But now it's kind of like the flip flop, and you're seeing a lot of people unfortunately laid off, a lot of good people out there in the industry, and a lot of companies, especially a lot of these bigger public companies that were, cannot go to any mortgage news outlet and click on refresh on the front page these last couple weeks without seeing some story about one of the real big guys laying off a big chunk of people. And to your point, like, opens up opportunity for companies like Alcova, right?
It does. It does. We're privately owned. There's myself and two other gentlemen that own the company, and we joke that good or bad, the buck stops with us. If we want to go a quarter and make a little less money, or even make no money, we can do that. We don't have a private equity firm that's pulling the strings, and I think that does help companies like us during these times. It can be scary, but again, when you look at coming off two of the best years in the history of the mortgage industry, I think you have to keep perspective that that wasn't going to continue, that anybody thought that was going to continue probably wasn't living in reality. Now, would we have liked rates to have risen as quickly and it'd be aggressively? Of course not. And does that create some pain? Absolutely. But again, that long-term perspective. And I think that's where, we try to live in is, what are we doing today that's going to make us a better company a year from now, 2 years from now, 3 years from now? And when we look at it like that, we see a ton of opportunities. Doesn't mean I don't wish there was a lot more green on the mortgage bonds when I get those price updates. But again, if we look at it long term, there's a tremendous amount of opportunity for us.
You guys, I never talked about, were you work from home prior to the pandemic? Where are you at with that now in terms of like bringing people back to the office? Or
Yeah, so we've always been very flexible in the work from home. We kind of had to. Our corporate headquarters is in Roanoke, Virginia.
mm-hmm.
Some of you may know where that's at. Some of you may be, where the heck is that? Small town in Southwest Virginia. So we did not have a lot of mortgage talent to choose from. So for underwriting, closing, processing, we had to go out in larger areas: Richmond, Northern Virginia, Charlotte, Raleigh, and Atlanta, places like that, to look for talent, 10 years ago. And so we were comfortable having people work from home long before the pandemic. So, it wasn't a drastic change for us. Now, obviously, some of the protocols and things that everybody had to go through, that was different. But, we were in a good spot there from work from home. And so we really haven't changed that much on our end.
And then just I think, the political landscape really, obviously we're going into a midterm election season. Me personally, I feel like housing is going to become a huge issue in the midterms, and in housing, typically outside of 07, 08, I remember it killed McCain. He couldn't really have the right responses to it. And I just remember him getting just pummeled in the debates about it. And I see it being a huge issue as we go into the midterms, because it's become such a Main Street issue. You talk about, the wannabe first time home buyer, and people got to live somewhere. Rents are going up like crazy, even more than home values if you look closely inside the numbers these last few months. And it's really causing a lot of pain to Americans that are trying to find a place to live.
Yeah, it is. And again, I'm a big believer in free markets, but I believe if we're going to get something from the government to help us, and so I would hope it's an incentive, and I would hope it would be an incentive on the sell side for people to sell their home, for something around capital gains forgiveness or relief for investors to sell. Some of these things it's hard to track, or it sounds better in principle than in reality. But if you could have a capital gains forgiveness for an investor who would sell to a first-time home buyer, or a reduction, I think those are things that maybe could move the needle. So we'll see what happens.
It's going to be interesting. Like you, I'm typically like a let the markets work it out guy, but something like that, like you just mentioned, or some sort of, we had the National Association of Home Builders president at our conference in Miami a little over a month ago, and he was just talking about the exorbitant regulatory costs in building a home. I mean, he got right up on stage and said, "Listen, you want us to build affordable homes in America? I tell you right now, it's not happening. It's $96,000 is the average regulatory cost. You want us to build a $250,000 house? That seems something is amiss there."
Absolutely. I have some friends that are trying to build now, and they're just having sticker shock. And they're like, "What happened?" And these are not first time home buyers. These are folks that have owned homes before, and they're just like, "Wait a minute, when did new construction become this expensive? I'm like, well, this is what happened. We got here largely through regulation, and the builders being stalled out, and of course all the material issues now with COVID backlogged and so forth, just expounded upon that. But yeah, we can only hope that somebody would cut some of those regulations and streamline a little bit, because that would be the biggest help that it could possibly be.
It'll be interesting to see how it plays out as we get closer to November primaries. I know in Ohio, a lot of other states today. So get ready for we've been seeing them in Ohio for weeks now, the political commercials, but interesting to see how much of a part of the narrative housing becomes. So Bobby, just a couple minutes left. Anything else that is on your radar here for 2022? Thoughts, predictions, things you're seeing, things you're focusing on with Alcova?
Well, again, we want to control what we can control. Our mission is to simplify the mortgage process, and our purpose is to create a better way to serve, not just serve our borrowers, but our team members and our communities. So those are the things we're focused on. We feel like if we stay focused on those things, then everything else will take care of itself. We do believe that the market is near the top, but we also are realistic that if it's not, then we have to accept that and continue to move forward. We are focusing on innovation, making the process simpler. We have used a great technology partner, so we do have more time now than we've had the last couple of years to come alongside them and really improve our process. So that's what we're doing this year. Is we're doubling down on that, and we believe that there is going to be another opportunity for some sort of refinance activity at some level, maybe not what we've seen the last couple of years, but enough to where it's going to be a nice, healthy bounce. So we want to be ready for that. We want to be able to take advantage of that. And we want really good people on our team. We feel like we've got the best team we've ever had. Everybody says that, but so for us, we're taking the opposite approach of laying off. We're selectively hiring. Obviously volume's down like everybody else. So we're not being stupid with it, but we are looking for really good people. And we want to grow the best team possible to take advantage of future opportunities. So that's what we're looking at. Market-wise, are concerned about the affordability. That's probably the biggest concern. It's really tough on first-time home buyers, and I think something's got to give there. I think maybe what's holding that up is that there's a lot of people that have wage leverage, is what I'm calling it, where they've either taken a new job or they went to their employer and said, hey, look, I deserve more money, and costs are going up, and their employers know how tight the labor market is, so they're giving them a raise. And I think that's what's driving the market absorbing the affordability. But how much longer can that continue? At some point, there will be some weakness in the labor market at some point, and that's when I think we'll really start to see that play out. Now, hopefully by then, rates are low or start beginning to come down. But I am concerned about the affordability issue.
A lot of sage words of advice from a guy that's run a really successful company for some years now. I'm envious. I remember when we first talked, your story, that's so cool. 3 buddies that all grew up together playing Little League baseball and started a mortgage company together. It ever get, friends owning a business together. It seems like you guys do it great, but
well, we haven't killed each other yet. So we're good.
That's awesome. Always enjoy the conversation on the industry, Bobby. Really appreciate you joining me as co-host this week, and all the best to you and yours as we get into the spring months here.
Yeah, and I want to thank you for what you do. You guys do, you and Angie and Ashley and Stacy and the whole team. It's very important to have a partner like you guys that come alongside and can provide us with information, with services, with vendors, with good communication, and just be a partner. So, I thank you. I want to take the time to definitely thank you for that.
Thank you. That means a lot to me coming from you. Really, really appreciate it. And appreciate your membership and and for you joining me today. Thank you, Bobby.
Yes, sir. Keep up the good work.
And to our attendees, thanks as always for spending 30 minutes of your week with us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. You can also find us on our YouTube channel where we archive all the videos, and on podcast where the majority of you listen. Find us there at TMC Connect on Apple, Spotify, or any of the other podcast platforms. Until next Tuesday, have a great rest of the week, everyone. Thanks again, Bobby.
Thanks. Take care.